What are margins and what is leverage? It may sound boring, but I find it is important to understand margins, especially as it relates to scaling and understanding the sizing of your positions in the market. Today, we'll be diving into the different types of margins required to initiate positions on any given contract. So, what are margins and how do they work? Margin is an earnest bond, or more plainly, the amount of money you need to deposit and have on hand in your trading account to open a position on any given futures contract. Unlike with equities margin lending, you're not borrowing capital to own the underlying product. In other words, margin on a futures position is not a cost to you. What are the different types of margins? Initial margin is the amount of funds required by the CME or other clearinghouse to initiate a futures position. While CME clearing sets the margin amount, your broker may be required to collect additional funds for deposit. Maintenance margin is the minimum amount that must be maintained at any given time in your account. And then you have day margin. Many brokers will grant additional day trading margins, which are lower than the exchange's requirements to open positions. Sometimes you may be trading a contract with $200,000 plus in notional value with as little as $1,000. This increased leverage magnifies risk, which can magnify losses as well as gains. Let's run through some frequently asked questions from clients regarding margins. Why do you care if I have super low margins? I always have a stop in. First things first, one, stops are not guaranteed to fill. I know that's a hard truth, but it's true. Two, and similarly, the market can gap beyond your stop price in large and fast moves. The next question is, the contract's liquid and I can manage my own risk. Why do you need to set high margins? I find many traders that ask this may not fully understand the notional value of the product they're trading. One E-mini S&P contract, for example, has a value of 50 times the S&P 500 index value. That means your one ES contract has a notional value right now of close to $300,000. To put this another way, imagine if I said you could trade almost 700 shares of Microsoft stock with $1,000. If Microsoft moved against you just $1.40 a share, you'd be out of money. This is the leverage you're working with in futures. If you're holding 10 E-mini S&P contracts with a $5,000 balance, your account could go to $0 in a matter of 10 points if you're on the wrong side of the market. Another question is, what is the lowest amount I can fund with to trade X contract? In my opinion, this is the wrong way to approach the market, and oftentimes this question comes with the idea that margin equals cost. As mentioned earlier, margin is not cost. It's an earnest bond, or the amount you need to have per contract to put a trade on. We fully understand people do not want to put huge amounts of capital into a futures account. After all, why does leverage exist if you can't leverage the ability to trade on margin? However, as mentioned earlier, leverage is already baked into these markets, even if you're trading on full CME initial margins. What you might find is that starting out with the smallest amount possible to place any given size on any given product might have you sizing down or refunding your account before you know it. Not to mention, if the exchange raises margins, you might find yourself handcuffed and unable to trade until you're able to sufficiently fund your account again. Think about the Microsoft example I provided earlier. So when do you have to have the initial margin? This one's a bit more straightforward than the previous examples. If you intend to carry a position in any market through the close of the trading session, that's 4 p.m. Chicago time for major indices markets and many others, you need to have the full CME initial margin per contract. Otherwise, you'll incur a margin call. That's all for today's EdgeShort. Thank you for watching and happy trading.